Hello and welcome to another episode of the Property and Lending Show, episode 10. As always, joined with us, Fadi and Mark. How are you, gentlemen?
How you going?
Good. Mark, how you going?
Yeah, we're good. How are you?
Good. Um, oh, you guys funny. Before we'll talk about interest rates, and obviously with the news with the interest rates rising for the first time in over 10 years. Last time there was an increase in interest rates, it was 2010 when they went up to 4.75. Since then, it's been steady or a gradual decline until most recently the interest rates were 0.1% since November last 2020, I believe, or 2020. Someone correct me, I'm not sure. It's been
It's
0.1 for a
big
while.
20.
2020, yeah. And obviously now it's gone up to 0.35%. And it's been under 1% since 2019, I believe. So it's still relatively, still 0.35% is a very, very small interest rate. But obviously it's the first increase and we're expecting more increases. So before we talk about what does it mean to the banks with new loans, existing loans, what does it mean in the property landscape? So someone want to kick us off and let us know what does it mean? Interest rates are going up. What does that mean?
Mark, you want to start?
With the interest rates going up, naturally when we do any calculations on the servicing calculators, the interest rate that the client has elected for whatever loan product they're after, whether it's fixed or variable, principal, interest only, whatever it is, that has to be input into the calculator. And then we spoke about it on previous episodes. They add a 3% buffer at this point in time, which I mean, that can always change as well. And then they calculate your monthly repayments based on that much higher interest rate. And that ultimately, by the interest rates going up, ultimately the monthly repayments that they would calculate that you would need to be paying with that buffer also goes up, which means your borrowing capacity essentially goes down, or you need a higher income to service that loan. So it does mean that servicing will go down when the rates go up from the bank's point of view.
Yeah. So money is getting more expensive. It's going to be harder to borrow money. Have we seen banks, Fadi, already pass on or increase rates already, or are they being a bit nice?
No. So, I mean, last night and today has been like just a lot of phone calls with his existing customers having discussion. What does this mean, etc. So they've increased the rate, the RBA yesterday by 0.25. So it's pretty standard in a standard world, but we haven't been living in a standard world in the last maybe 2 or 3 years. So they've actually 0.25 is very standard, but it hasn't been added on. Like you said, in the last 10 years, it's just been going down basically. And usually when the RBA do increase their rates in the past, before COVID, lenders will be passing on like 0.12 of the 0.25 or 0.15. They usually wouldn't pass the full amount, not in most scenarios. But I think like Mark will attest to this, today we saw that basically the majority of all lenders have passed the full 0.25 points across. So that goes to the variable rates as well.
Yeah. Okay.
So all these variable rates that we were discussing maybe a couple of weeks ago, how the fixed rates have gone up. Now they're trying to check customers through with the low interest rates. We've already seen a hike of 0.25 into the variable interest rates, and I don't see it stopping anytime soon.
Yeah. So if I have an existing home loan, my interest rates are going to go up if it's a variable rate. Is that what it means?
Correct.
Cool.
Yeah.
And regarding someone wanting to buy or get a new loan, I guess as Mark and yourself mentioned, they've already passed it on. And with the buffer, are we expecting to see people, I guess, have lower borrowing power? Is it going to be harder to get a loan? Is that really what it means with an increased rate?
Yeah. So like Mark touched on it. So basically, when we're putting numbers into the borrowing capacities of any lender, they add that buffer to the current interest rate that we're applying for. So we can be applying, like in the past during COVID, we were applying with 1.98, and we'd add the 2.5% buffer that was on there, a couple of years, like at the beginning of this year. Now that buffer's gone to 3%. We're adding a 3% to not the 1.98. We're adding 3% to, for example, let's say the average basic variable is at 2.99% on today's market. Yeah, so we're adding to that now. So we're adding a 0.25 to the 2.99 basic variable, and that goes to, what is it? 3 point, I hate maths, man.
We'll go to 3.25 essentially.
Yeah, essentially, yeah.
Yeah. Okay. So money's going to get a bit harder to borrow. Is it just going to be a lower borrowing power that we're finding, or is it going to be harder in general to get money as well? If that makes sense.
I think it's just mainly the borrowing. At the moment, there hasn't been like the policies pretty much are still in place for pay slips, tax returns, self-employed, full employed. But we also see changes in that as well moving forward, where we see the banks being a little bit more conservative. Like you were saying at the beginning of the podcast, you mentioned how money is going to be a little bit more harder to borrow now, where we've been used to the last couple of years where it's been so easy. It's like easy access. So once we see a shift in rates like this, the lenders do get a little bit more conservative in regards to checking a few more further details. So it may be not so much difficult, but just a few more boxes that we have to tick off.
Yeah. 0.25% is not a huge increase, right? And like we've been working with historically low interest rates. And I mean, anytime interest rates go up, people panic. Mark, do you reckon, I mean, have you seen a shift already on your end? I haven't personally. I've had a couple of real estate agents call me and say that they've seen a shift very quickly from their side. Sellers want to sell because they want to, before they think it's going to keep going up. Have you seen a shift on your side in terms of sentiment or any change?
I mean, naturally, with people refinancing, it's obviously very time sensitive, especially if they're going for a fixed rate, because if they don't choose to rate lock, which you'd be crazy to not do at the moment, whatever rate is effective at the time of settlement is what you end up getting, even though initially it may be listed lower. So definitely for refinances, because they are very time sensitive, people are a bit more anxious. But I mean, when you have the rate lock in place, that sort of counters that, and that's kind of your insurance against the interest rates going up. So change of sentiment to buyers. I mean, naturally we have conversation with people every day. Even today, several clients we have conversations with them, and they on the fence whether they want to sort of put a pre-approval in place and start looking. But then now with interest rates going up, they naturally feel that property prices may be on their way down, which may not be the case. So yeah, there is a change in sentiment from buyers, and also people refinancing are a bit more anxious as well.
Yeah, I've seen a lot of, I mean, the media, anytime I read anything in the media about property, I kind of just disregard it. But I was tagged in a few posts on a few articles, sorry, about property markets set to plunge 500,000, 400,000, 300, like it's utter nonsense, right? But I think like when you break down, so I did a quick calculation, like what the change means in terms of existing loans, if it's just a 0.25% increase, if you have a $400,000 loan, it's equivalent to $12 a week increase. 600,000 is $18 a week. 800,000 is $25 a week, and $1 million loan, it's only $30 a week extra.
Can I be a devil's advocate?
Please do.
Can I do that? Because this is one thing I wanted to mention as well, in regards to what you're saying now. One of the major differences that are happening now, people are forgetting that banks have already started increasing rates before the RBA increased their rate yesterday. Yep. And they increased by quite a bit in the last couple of months, where RBA have left it at 0.1, but the banks, it's in their control. They can increase it whenever they want, basically. And today, it just seems like they've just taken more of an advantage to up it as much as they can if they're taking advantage of the whole 0.25. Now, the differences that can make is that a lot of our customers, or Australians in general, are going to have to get used to the fact that we've been on honeymoon rates in the last couple of years. These rates have been record. Like, have we been living in a time where rates have ever been this low? Like, I can't remember it. Like back in our parents' days, it was about 17%, and we've seen like a low. We were happy before COVID hit at 3.75%, like we mentioned before as well. Yeah. For example, on a $550,000 home loan, something I was discussing today for one of my customers, a $550,000 home loan, he's on a three-year fixed. That exact same product on today's market, for that same amount, if you were to buy that house today, let's say at the same price, and go on that product and that rate, it went from the 1.98 to the 4.49%. He's paying $870 extra per month. So when that honeymoon rate's up and the rates are around the 4.5%, that's an extra $870 per month.
Yeah.
Yeah.
For sure. for sure.
Yeah.
I guess my point is where we are at now is still very reasonable.
Well, absolutely. It's going to be a lot more reasonable.
As a 0.25% increase alone, it's fairly
Yeah.
reasonable. Obviously, if it continues to rise and gets to those, that's a big difference. Obviously at 2-3% and 4.5 or whatever, huge differences. I don't know if the RBA will increase it so much that you get to that kind of rate. I mean, an increase in interest rates from the RBA is a sign that the economy is doing well, and it has been. Unemployment rates are at like record lows as well. So it's part and parcel, part of the package. But it wasn't that long ago, like you mentioned. It was only 2019 when the rate was. It was only 10 years ago. It's not that long ago, where the rates were 4.75 or whatnot, and people were investing and life went on. So I just think the panic is a bit too much. Is a bit very reactionary. From my perspective,
I could understand it. Yeah.
I can see. I mean, someone with a lot of debt.
Yeah.
I'm having to look at my loans and thinking, how much more am I paying? But like I've been asked a few questions today and yesterday from our clients and prospective clients saying, well, is this the right time to buy? And if we remember COVID, people asked the same questions, and the answer was a resounding yes, right? And Warren Buffett be fearful when others are greedy, and be greedy when others are fearful. And you're going to find a lot of opportunities. But one thing from my perspective as a buyer's agent and on the floor every day buying property, Australia is not one market. And over the last 20 years of real estate data that we have accessible, we have never seen the market, all of Australia move together in one line. You have Sydney, Melbourne doing one thing, Adelaide doing one thing. There are markets within markets. And, to answer the question, is now the right time to buy? My stance never changes with that question. The answer will always be the right time to buy is when you're ready, because you're buying property for 20 to 30 years, and the short-term fluctuations are not going to change your overall strategy, your overall game plan. It might change what you buy and your borrowing power, but the end goal stays the same, and how you're going to get there doesn't really change too much. I don't know if you have a different opinion.
Yeah, I just think as well, like, given the amount of customers that have come through and like gone through your services, it's also, we find a lot of them investing interstate, which I'm always a fan of course, where it's not really, you're not going to be spending your last dime to purchase a house there. The rental yield is a lot more better than it is here as well. For me personally, Sydney in general, unless you're buying an occupied home, I wouldn't invest in Sydney. That's me, of course. But I couldn't even answer that question right now, because one of the most awkward applications that we're doing now is refinances, where we're refinancing people that are coming off the 1.98 or 2%, and then we're giving them or quoting them the rates that we're given by the lenders. And then there's that question of, okay, so do we fix it again, or do we leave it as variable? It's a question where it's just so awkward to, like, no one knows. No one knows. And we can't actually answer that question. But I look at them looking like, I don't know. Like, the rates right now for variable are low. I don't know if they're going to increase in the next couple of months above the fixed rate that we're trying to go through, or are they going to stay less? So
I think that's why it's important to really know what your strategy is and what you're trying to achieve. Because if you don't know, and you're basing your entire strategy and your portfolio building decisions on what the current interest rate is or what it might be tomorrow, you're not really planning for the future. You're planning for the now. And then, people who bought 10 years ago at 4.75% have made a lot of money in the last 10 years, right? So, I think you have to really have that long-term plan. Just a quick question. I think we touched on another episode. I think, Mark, you were talking about it. Someone that's been in the process of getting a pre-approval review, or has potentially just gotten it, like, say 5 days ago, at a certain rate, will that change? Will that rate change now when the banks have changed, or does that kind of get locked in, I guess?
Yeah, absolutely will change. Your rate, if it's a fixed rate, your rate is never actually fixed until you've signed the contract of sale and the broker has elected that you want to pay the
rate.
The rate locked, correct. Once your rate is locked, once you've elected that with the lender, then it doesn't matter what happened to the rate, doesn't matter how much higher it goes, so long as you settle the loan within whatever it is, like for example,
90 days.
some 90, 100, whatever it is. As long as it settles in that time, which obviously 90 or 100 days for a settlement is more than excessive, so that's more than enough time. As long as it settles in that time, you will be locked into that rate. If you don't elect the rate lock and it's a fixed rate, it will, if the rate goes up, your elected rate unfortunately will follow, and it will be whatever the rate is on settlement day, not when you sign the loan documents, not when you sign the contract of sale, on settlement day.
Yeah.
In
So
terms
what's
of
your advice?
variable rates, it would have changed anyway. Like even if you did settle and then the rates change after it, I mean, it goes up anyway and it will follow, and you'll see that in your statement. So
Yeah. So do you have any advice to potential like clients or customers who are thinking about buying from a borrowing perspective? Any advice? Get in now, wait a bit. What's your take on it?
for anyone that's already pre-approved, or anyone that's applying for pre-approval with me now, I always tell them before you sign a contract, just give me a call. Let me just run the numbers again with the rates on that day in case they have changed on the calculator. I also keep track of the pre-approvals with the different banks, because as soon as the interest rates change, I let the clients know as well, just so that they're well aware. Because that might change the yield they're going for, whatever it is from your end when you're looking for the property. So just being informed with the lender that you're going through definitely is important, and keep your broker up to date before you sign the contract of sale, rather than sort of being surprised after you sign the contract is always better.
I feel like we say that line every week. You
Yeah.
should change the show. Call your broker, please.
Okay, I'm going to be a little cheeky. I know you touched base just before I asked Mark the question in regards to, people that invested 10 years ago and they got at 4.75% have made money in the time. So my question is, obviously the rates are going higher, and like the theory is the rates go higher, the market drops. So is that the scenario where we're going to start seeing these rates going higher and higher? And obviously, from my perspective, we have to see a shift in the market. It has to drop. That's from my perspective. It just needs to, because people are not in a position to be purchasing for those prices no more, because the banks are not allowing them to have that, that money no more. So that's another question that, a lot of the questions I received today from our customers is like, do we just wait? Yeah, we're going to get on a higher interest rate, but we'll get the property at a lower amount. But like you said, it's a 10 to 30 year investment. So what's your say on that? Like, is that, like you just said, ask Mark, what would your response be?
Yeah. My response would be, I'm not waiting.
Yeah.
Personally, like you both know, I'm trying to get another, purchase another property myself at the moment. And the reason is, I always go back to it. There are markets within markets within markets. And yes, interest rates going up. Overall, generally, you'll see certain markets dropping. And usually the trend is you have your super high level suburbs, your $5 to $10 million suburbs. They're the ones that first drop, because the demand for those areas is already very, very niche. It's a very small amount of people that can buy those areas. And those are the areas that are obviously the most affected. A small percentage change on a $5 to $10 million loan is a huge amount of money. So those are the first areas that you see dropping, because the demand is less. And then it just goes down the rungs. Your 1 to 4 or 1 to 3 million will be, affected a bit later on. And then your 700,000 to $1 million in Sydney might not even be affected, right? Because the demand for that product is so high, regardless of the interest rates go up or not, there are enough people that are still trying to buy in those areas.
I'll get that property, yeah.
So it is the supply. In those 700,000 to $1 million areas, are people going to be under mortgage stress? Do people have a need to sell? If they don't need to sell, they won't sell. The stock stays high, and then that market will drop. If there is a need to sell, if they've already overextended themselves, first home buyers borrowing 105% or whatever, if they're pushing to have got in already when the rates were so low, if it becomes a problem, you'll see a little bit of an increased supply. But if the demand for those areas is still fairly high as well, you sort of get a plateau. You don't really get a drop in those areas. You kind of just get a 12 months of nothing. But when you're looking in, the areas that we purchase in for our clients is very heavily analyzed by a lot of data, and a lot of data metrics where we are looking at, we're using quantitative data to work out a qualitative question: where do people want to move? Where do people want to live emotionally? The one caveat to everything when it comes to property is that property is an investment not dominated by investors. It's the only market in the world not dominated by investors when it comes to investing. It's owner occupiers. People are emotional. So we're looking for those pockets, and we've purchased in Adelaide, we purchased in Brisbane, and I mean, me and Mark, we just bought one yesterday. Mark sent me a message. The valuation, the bank val came higher than the purchase price by almost $50,000, right? So there are areas that will be unaffected because there's an emotional want and need for it, no matter what happens externally. So is the right time to buy? Like I said, depends if you're ready. If you're ready, I will be buying, and I'll be taking opportunities because there will be opportunities coming up. So that's my outlook on it. Because in 20 years' time, it's going to be worth more than it is today, right? No matter what, the interest rate.
I hope so.
High chance, the demand will continue to increase and supply will continue to decrease. So just naturally by, births and deaths and whatnot in the population. So you got to be buying in the right areas. You can't buy anywhere. If anyone threw a rock at any house in the last 2 or 3 years, they made money. Now you got to be more sophisticated about it and really buy in the right spots. So that's kind of my take on it. Anything else to add about?
I was just going to say, I think when people talk about it, whether it's the media or you start a barbecue talking to people, I thought a lot of people, I think, dumb it down too much. I think it's not rates are going up, prices must follow. There's a lot of things in play. I mean, the unemployment rate is at an all-time low now, meaning a lot more people are in jobs. A lot more people can go to a bank with a pay slip and get a loan as well. In July, there'll be tens of thousands of first-home buyers back in the market from the government. So there's going to be an influx of first-home buyers looking at that properties under 900 grand in in Sydney, for example, and obviously with the different price caps in the different states. So and obviously with the increased demand for those properties under 900 grand in Sydney, I do suspect that there will be prices. I don't think they will go down. So I think there's a lot more factors in play with this. I mean, the war also affecting inflation. I mean, if that stops and inflation goes back down, rates may not continue to increase all that long. So, I mean, there's so many moving parts. There's so many moving parts.
For sure, it is. It's very much more so, more like technical than rates went up, prices go down. Because you're right, like I kind of mentioned, the RBA increasing rates is a sign of an economy that is doing well. Interest rates go down when economy is not doing well. So you're right, interest rate goes up, but more people making money, more people have money. So there's a lot going on, and I think that's why it's very important. Data, know where you're buying. Don't just kind of guess. Speak to your broker always. Anything else to add? Should we wrap it up?
Yeah.
Let's make it a short one. I think we're getting better at making short ones. So now we're at
31 minutes.
All right. We'll sign off on this one. Thanks, gentlemen, as always. Until
Thank you.
the next episode.
Thanks, boys.